All right, so moving on from here, and I think this is a crucial topic because we've heard the panelists raise this before, and this is more about safeguarding the downside. Tom mentioned that even after they quit a matter or they terminate the agreement, there is a chance that they need to pay the adverse cost. Adverse cost essentially being cost follows the consequence. You may lose the case, and if in that case you have to pay the other side's fees, especially if Alistair's on the other side, his fees is pretty hefty. You need to pay his fees. And how does someone cover his fees? So that's an important question. And how does the funder cover that fees? But more importantly, sometimes in the middle of the litigation, as Sindhu pointed out, when the client is insolvent and you're raising funding, you're going to come and say, sorry, you're not going to be able to pay my fees. You secure my fees in advance. And security for cost is something which is very often. In fact, in the Indian context, there are specific rules for security for cost in the Indian civil procedure vis-a-vis funding. Order 25 of the Civil Procedure Code of Maharashtra, Gujarat, MP, and UP specifically say that in a funding scenario, when a case has litigation finance, you may add the funder as a party if the funder consents, and on your own motion or by an application removed from the other side, the court may require the funder to put security of the entire amount. So there is legislation in India which points that if you're before courts in Maharashtra, which is the Bombay High Court, or in Gujarat, or in MP or UP, you need to give security. The same is true for international arbitration. Rules provide for security for cost, and international arbitration applications of security for cost are not as often as you see in litigation, but they do come in when you see impecunious claimant or if you see a funded contract. Rightly or wrongly, they come into play. My question to Tom is, how do you tackle this? This must be increasing the pressure of the case on you. It's no more the same budget. It may almost double. How do you tackle security for cost? How do you tackle adverse cost?
Well, adverse cost is certainly a risk factor in cases that we fund. And there are different approaches between different funders on this. Our approach is typically, if we are funding the case, then we will also take on the adverse cost risk. And that's something that we have always done over the 20 years that we've been funding cases. And we find that if we back the adverse cost risk, then that usually effectively deals with any security for costs issue as well. And what we will do is provide an undertaking to the court or the tribunal and the respondents to say that we are on the hook for adverse costs, and you may make an order directly against us, and we will pay those. And that is usually a complete answer to security for costs. And certainly in the arbitration context, where the jurisdiction of the tribunal is one of consent, the funder would have to submit to the jurisdiction of the tribunal in order for them to be able to make any award of costs against the funder. If funders aren't willing to do that, then there's every chance that a tribunal or a court may order security for costs to be paid, and in those circumstances the funder would have to pay in or provide some sort of guarantee, probably unless the party can do it themselves. The alternative approach that we see from a lot of the other funders out there is to require parties to purchase an adverse costs insurance policy, or ATE insurance policy. The downside of that is that it's very expensive. It takes a long time. So not only do you have to do your due diligence process with your funder, but you have to do it with your insurer as well. And then thirdly, when it comes to the issue of security for costs, courts and tribunals have typically struggled more with the concept of relying on an ATE policy as effective security for costs than a simple undertaking from a financially transparent and, in our case, publicly listed litigation funder. So it's a relatively complicated issue, and there are differing approaches.
And Sindhu, how do you guys approach the concept of ATE? Do you follow the approach of indemnity as Tom brought up, or do you look at underwriting And if you look at underwriting, is it deal by deal or is it in a portfolio sense of it? How do you approach it? Is it different from Omni Bridgeway?
The way we approach it is almost exactly what Tom just described. If we fund a case, Insworth will cover the adverse cost exposure of the claimant. There are some funders who follow a similar approach, and equally there are many who don't, who will make it a precondition to funding that the claimant has to go out and procure ATA insurance in the market. As Tom pointed out, and I entirely agree with that, that not only adds a significant amount of time to the whole process, but it's also it can be a logistical nightmare for a claimant and for the law firm, particularly those who are not very experienced with the ATA market. It's not the easiest to navigate, and it can be quite expensive. And again, very similar to what Tom just described, the other advantage, obviously, of having a funder like Insworth cover the ATA or cover the adverse cost exposure is that it's inevitably a complete answer to any security for cost application that may be made against the claimant. I mean, Insworth is owned and funded by funds owned by Elliott Management, New York hedge fund, and which has 40 billion plus assets under management. So that will be usually a sufficient answer to any security for cost application.
Well, that's a very good answer, and I think if people are able to get funding from Tom and Sindhu, they don't have to worry about adverse cost and security for cost. But what about when you don't fund them? Tom, when you said when you don't, when the case is not backed by your indemnity, then you need to get ATE. And how does it work for the Indian market? Is it easy to get ATE for the Indian market? What are the challenges?
Well, my understanding is that it's not easy in India at all. The ATE market principally is run out of the UK, and I don't think it's yet wrapped its head around the risks or otherwise in India. And generally, we have heard from others that it's difficult, if not impossible, to arrange ATE for domestic cases in India. It might be less likely of an issue for international cases, but I think at the moment it is problematic. But as I say, apart from that, there are the issues of time and cost associated with that product. And I think if you have the choice between a funder that can provide an indemnity and one that can't, I would go with the former.
Very good. And last question of the theme before I hand over to Montec, it is to you, Alistair. You sit a lot as the tribunal member, and when you are the tribunal and you need to decide how to award costs, and you see Tom or Sindhu on the other side, does that change your mindset in awarding costs?
I think for some reason the expression third-party funding sort of excites interest as if it's some extraordinary different animal. We're just talking about one way of funding a party bringing a case. And you might as well go and take a loan from a bank or borrow from a parent company. This is just a way of acquiring finance to pursue a case. So should an arbitrator, in considering a costs award, take into account that somebody is being supported by litigation finance, by a third-party fund? Well, no, I don't think so. Why would the tribunal be influenced by that any more than they should be influenced by the fact that somebody's taken a loan from the bank or borrowed from their parent company? So the principal answer must be no, tribunals shouldn't be influenced at all by the presence of a fund. There is the issue of security for costs, which we've talked about, where the presence of a fund may come directly into the deliberations of the tribunal, but we've heard a little bit about that and I won't go there. Can I tell you that every arbitrator ignores the presence of a fund when it comes to making a cost award? No, I can't tell you that. And I know from my experience sitting on tribunals that there are some arbitrators out there who I've heard say things like, well, they are funded after all, so maybe we should think about doing this with the costs award. Now that's rare, it's not right, but I can't tell you that in every case people ignore it, even if in principle, in my view, they should.